Hello and welcome back. I saw this tweet the other day and I really needed to speak about it. It's actually a bit of an older tweet, but it is showing Microsoft's enterprise value, which is a proxy for stock price, um, and its trailing 12-month sales since 1995. So, in case you can't see, it starts all the way in 1995 and it basically just goes up slowly up and to the right. That's the red bar at the bottom, pretty consistently. And meanwhile, we see the stock or the enterprise value, which again, proxy for the stock price, which shoots up massively up into 2000, and then it pops in the 2000 dot-com bubble. Basically, then it's flat from 2002 all the way to 2012. Actually, a little down, but until 2013 it's flat, and then since 2013 it's gone up a ton. And to me, this perfectly encapsulates the market environment we're in. I think we are in this 2000 area here, where there have been companies that are amazing companies and going to be companies of the future, just like Microsoft, that are going to be huge. But we got a little overexcited. And that pushed these values up to really high highs. There's going to be a bit of a pop. There's already been in a lot of growth stocks a bit of a huge pullback. I've mentioned a couple here, Zillow and Peloton, which have seen their values cut by 50, 60, 70%. Um, Despite that, I still think the underlying business is going to continue to grow, creep up. And as we can see here, in the long run, it will matter. But in the short run, you can see things where a company says, well, we got a little bit ahead of our skis, the valuation's not there yet, it pulls back, which draws on a negative sentiment and can keep the stock price depressed. I personally don't think you'll see this extended period as long. Like 12, I don't think a company like this can grow at a great rate like this for 13 years and not um, not see its stock price go up, but I do think it could happen for a couple of years. And I even called up in the Peloton video here that I think the underlying businesses continue to do well and grow, but I think the stock price could stay deflated for the next 3 to 5 years. I hope less. I think maybe a little less than that, but it really well could. I think bust and boom cycles are much shorter. I think Bitcoin, the internet, the freeing of information, everyone kind of knows to buy the dip now. So I think there's a lot of things that have made cycles boom and bust much quicker. Even with I'll call it the Corona crash, I think that was the quickest rebound to underlying levels, and we haven't seen something like the Depression or Black Monday or any of these stock market crashes that last 5, 10 years anymore. Again, dot-com bubble was the last extended crash, and even there, it was isolated to a specific sector. It was not the whole market. It was just the dot-com style companies that were really hit hard for an extended period of time. Other companies rebounded relatively quickly. Same with the 2008-9 recession. People forget how quickly a lot of companies actually bounced back from that. And actually, again, and now we all know, hey, when there's a crash, it's a great buying opportunity. So that's, I think, a big reason why people, these crashes and dips are not going to last as long. So when I look at the data here, this is not the actual price to sales ratio, but this is how it trended versus what it was in 2009. And as we can see, the change really has been in, obviously, again, revenue kept going up. So the only thing that's really changing if the revenue went up, and I also checked there's two things that could change. You could either have higher earnings, in other words, you're just like I call that in Peloton. You can have higher sales, but maybe your margin profile moves. Oh, we used to sell equipment, which is a low margin item, and now we're selling software, which is high margin. So the total revenue could keep growing like that, but your margin profile could change dramatically. That actually didn't happen to Microsoft. They've always been a software company, Microsoft, and big part of the revenue's been has been some devices, but a lot of software. And I look back, and it's always been a very high operating margin. So that has not changed. So if that's the case, there's really only one reason why, if sales continue to go up and to the right, why stock price would change, and that's the multiple that you're willing to pay for those earnings. So what would change earnings so dramatically? Well, I think the answer, there's a couple answers. Like one, you could change your thoughts about the future this company could change. If a company is growing at 100%, you're going to pay a higher multiple. But if the company is growing 5%, you're going to have a lower multiple today. But I think companies are smarter and they don't just look at today's PE, they forecast out. And as we can see, like Microsoft did have a very long runway. People might have thought, and I think they did, that the runway was shorter than it was, so that's one reason. I think a much larger reason, though, for why there was such multiple compression during this time is alternatives. When you invest in a stock that's growing 10% a year, even if it's growing 10% a year like Microsoft, you can see it can drop 80% in a 5-year span. Um, so there's a lot of risk involved. Meanwhile, bonds back in the day were yielding 5 to 10, some years even 15%. So why would you take a risk like this when you could take a bond, which is basically a sure thing, the U.S. government not defaulting, and get 10 or 12%? There's no reason why you wouldn't, which is why bonds were much more attractive. Today, bonds are yielding much less, 1, 2%, sometimes 3%, depends. Junk bonds are even only yielding 3.5, 4%. So when that happens, you're willing to pay a premium for something that's yielding more, like a stock. So again, interest rates, I made a video on this. Interest rates being driven down over the last 50 years or so has really been something that helped companies like this. It's expanded their multiples, especially in the last few years when it's really dipped low. It's been 2, 3% interest rates, even lower. So that's been one thing. But the other thing I wanted to point out, so I'll show you here the price ratios. We can see here the price sales ratio. We can see again it went 2, and now the price sales ratio is at 14 times. So pretty significant premium. And this is actually when you do best in the market, is when you have two things. One, underlying growth. So again, the company has to continue to grow. But when you have underlying growth and multiple expansion, you get a company like this that has gone, I won't say parabolic, but it's up in the last 5 years 400%, just about. And that's not including, it's got a small dividend, but still. So that's how you get these amazing winners, is when you see both growth in the underlying company and multiple expansion. When I look at most growth companies out there, most companies I really like, I go, do I think the multiple is going to expand? I think no. Most likely the multiple is going to contract. We've seen companies now that are trading at 60 times sales, or 150 times earnings, 200 times earnings. Earnings, I think, is a tough one to look at because you can get operating leverage, and I'll make another video on that because I think that's a really important idea to understand. But the biggest one is price to sales is much more stable, especially if your margin profile is not changing. And if that's the case, do you think some of these companies are going to trade for a more reasonable price to sales ratio in the future? And I think not. Let's look at Cloudflare. Cloudflare. And when we look at their price ratio, I'm not picking on them for any particular reason. I just know they have a high price sales. But when we look at it, they've got a 52 or 60 times price sales. So is there any chance that you get an expansion on that? No, that's extremely high. So really what you want to find, if you really want to hit a multi-bagger, that's a company that goes up 10x, is you want to find a company that you think trades at a reasonable or even low multiple and has great growth. Unfortunately, everything's priced into the stock normally, and if someone thinks that there's great growth, that's going to be priced into the stock. And so even if it grows at a good clip, you're not going to see it go up significantly. If you're expecting 30% growth, revenue growth, and then it grows 30%, you're not going to see the stock go up a ton because everyone knows that. So this is my way of saying, I think we're in this part of the market here where we are seeing a pullback. I think this whole thing is going to get compressed. So I think there will be expansion. I think there will still be some winners that in 5, 10 years, less, 5 years, are going to have amazing growth because the underlying business continues to chug along, but all the hype around it has gone away. So if you're a long-term investor, you can stick in those companies, but all depends on what style you are. If you're looking for a short-term gain, I think the market's changed and you're going to be looking to switch into financials. People are worried about inflation. Growth has really had all the air sucked out of it. But if you're in it for the long haul, like I am, I'm still a believer in these companies. It could take a while though. So just buckle down and, not everything's going to hit, but I really think that some of these companies are going to be bigger. And that's really what you have to ask yourself. How much bigger is this company going to be in 5 years? And is that multiple going to be higher? And I think those are the two questions you really want to answer. And something like Microsoft, as you can see, just continue to chug along and said, who cares about what the market says I'm worth? I know what I'm worth, and eventually the market will catch on. So thanks so much for watching, and talk to you next time.